Traders, how are you? With Marcello, founder of the Day Trading Academy. I had a question with this Ask Marcello series about what are synthetic indices. And I've been in this industry now for almost 23 years, and I have never heard of these things before. So I started digging, and I started seeing kind of, who it was from, who it was with, how does it work, where they registered. And in all honesty, it is an absolute scam. Let's go ahead and get started. So if you do have any other questions or things that you want me to go and investigate, I got animated to do these videos again for you guys. Just leave the hashtag, it's right here, Ask Marcello there in the comments. It'll be simpler for me to kind of go through the messages. The synthetic index market is relatively new, and it comes from another company that I find to be a complete scam, which is binary.com, right? That's my opinion. And so what I'm going to do in this video is I'm going to explain to you what synthetic indexes are, the benefits, quote unquote, that they say that you have when you trade them. P.S. There's no professional trader that trades in this garbage market, okay? And I want you to understand where it comes from. And honestly, there are an amazing amount. This trading industry has grown in a beautiful way since I've been in it for the last 23 years. A lot more access. It's a lot cheaper. There's a lot of great traders now. So I'm not doing it to bash a company. I don't want you to come and buy something from me or anything. I just want you to literally stay away from this market because I think it's a complete scam, and I don't want you to lose your money like a lot of people have in cryptos or in FTX or in binary options. Okay. So I did some digging, and I'm gonna read to you from just a website that I found exactly what they are, and this comes from actual exchange page where they're offered. Synthetic indexes are actually only offered by one company, which to me is a red flag. The company is called derived.com, and this company is. One of the things I always look at is where people are registered. It's okay, I think, if they're registered in these secondary financial markets, like one of the islands like Cyprus or Malta. And a lot of times what they'll do is they'll have a base kind of in their main country. For example, Pepperstone, which is the Forex broker that I recommend for non-US citizens or residents. It's a great broker because they're registered in Australia, but then they have other let's say registrations in the Bahamas and things like that. But I always like when one of these companies are in kind of one of these more strict regulation districts. This company is in Malta. It's in Malaysia. It's in the British Virgin Islands. It's in Vanuatu, which is an island in the Pacific. And it's also in St. Vincent and Grenadines, which is in the Caribbean. Not one place do they offer, not from Europe or Germany or Australia or the US or anything like that. Okay. So synthetic indexes are, quote unquote, simulated markets. They're not real markets. They're simulated markets that work like real markets. But the price numbers are generated randomly by, quote unquote, fully secured computer program. And this program is handled by fully independent third-party companies. Now, I want to kind of explain how trading works, because trading is essentially an open market where you buy and sell certain financial products. And the reason why the prices go up and down is because of the demand and let's say it's fear and greed. It's essentially how many people want to buy the financial product like a stock, right? Which is the demand, and how many people want to sell, which is the amount of people who have fear or want to sell the actual product. So what happens? Let's talk about Apple stock. If this is I'm gonna get in the camera here, right? I think it's better over here. Okay. So if we have people that want to buy the stock at a certain price, and there's a lot of people that want to buy the stock, and let me change cameras here. So if a lot of people want to buy the stock, right, and a lot of people have demand for it, they're going to keep buying and buying and buying. So that's going to sell, all the orders that are completed at this price, and then the price is going to continue to rise because there's more people that want to sell higher, and then that's why the price keeps going up. On the flip side, if there's a lot of people selling, but nobody is buying, right, then what will happen is that people will drop their prices to make sure that those orders are filled, because the orders are supposed to be public. And that's theoretically, in a very simple way, how the stock market works. There's buyers and sellers. If there's more buyers, the stock goes up. If there's more sellers, the stock goes down. And that's in any financial product. Futures, for example, is the same way. That's what I primarily learned on. That's what I recommend that you start on as well, because it's cheaper and everything. I'll do that in another video if you guys want me to. Forex, for example, is a market that isn't centralized, so there's not a central location where people buy and sell. So what happens? Instead of charging a commission for you to put in a trade, for example, it costs me $7 or $5 to buy or sell, they charge what's called the spread. And then we have other quote unquote make-believe markets like binary options. And then this new market called synthetic indexes that literally aren't real markets. So the question I have for you is, who is making the price move if there aren't really people buying and selling? Right? And this, supposedly, it's some computer programs. If you want to believe that, go ahead, but I don't. So the reason why they charge what's called the spread is because they can manipulate the price that your order is generated and executed at, because the market doesn't really exist. It's just a made up market, right? So some of the advantages that they're going to tell you is, well, it's available 24/7, including holidays and weekends. Well, if everything's closed on a holiday, how are they going to take your order? You see, it's just literally made up. You don't need a lot of capital to start. Supposedly you can start with $1 or $5. It's only offered by one broker, which is Deriv. The synthetic indexes has a low spread, which is one of the advantages that they claim. And obviously the low capital part. I had that written down here on the list. So what happens? Due to the fact that it's a literally made up market, they can do whatever they want. And they're not registered in a, let's call it a more legitimate location like Germany or France or the UK or Australia or the US. And that gives me a little bit of alerts because, well, it's a made up market. They can do whatever they want. And then at the same time, they're not really in a regulated financial country, let's say, right? And so that's the first reason why I wouldn't recommend it. And I think it's a complete scam because in markets like stocks and futures, there is no spread because they can't manipulate the market as much because it's an actual real market, not just a made up market. Okay. And another thing is, if you're watching this video and you want to invest in the stock market and you want to become a trader, you want to be where people are at, professionals are. There's not one professional trader in the world that trades with this new market. It's literally new. And I'm going to show you here. There's a website called, oh, and one thing I forgot to show you. This is in their risks. Check this out. This is in their risks and the risk disclosure. You should be aware that all trades through Deriv are made on an over-the-counter markets. This means that listen to this. This means that the trades that we offer do not take place under the rules of any recognized, designated, or regulated exchange. As a result, engaging in these trades may expose you to substantially greater risk than the investments that are traded under such rules. And this is what I just explained to you a moment ago. It's literally just made up. And they can manipulate it however they want because they're not regulated. You see how it works? So the company, and I'm going to pull this down here so I can get to the tabs that I need. So the company Deriv is not originally Deriv. If we go back to what's called the Wayback Machine, which is a website that you can go to, which shows you the updates of the actual website. In 1996, notice that this was some kind of, it looks like some kind of just another kind of company that was offering something, right? Some kind of financial products. Then if we fast forward a little bit, which is July 2003, binaryoptions.com redirected to Deriv. Okay. So 1996, it was just like a made up website. 1996, then it appears binary.com. And now we have, if I show you here the map of all of the updates to the website, notice in 2020, all of the updates, and 2020 is when they officially launched, quote unquote, this product. So it's literally what, 3 years old, maybe not even. And if you go to binary.com, notice binary.com has been around for 2 decades, 20 years, and now they're Deriv. Alarm bells come off when I see a lot of these companies changing their names or changing the way that they do things. And the reason why is because it kind of seems to me that they expired, they spent all of their scam in the market and customers no longer trust them. So they have to change to another company name. So binary.com used to be a binary options broker, and binary options to me is like the trash of the financial industry because it's another market like synthetic indexes that aren't real. They're completely made up. I've traded in binary options. And something really weird happened where I put $5,000 in. It was a robot that I had some of my guys developed and went up to like $20,000 or 30. I can't remember the exact number, but it was a big profit. And then all of a sudden it just lost everything. And this is why you want to be really careful with these markets that aren't regulated, right? Because they can just do whatever they want. And it doesn't benefit them if you win money because you're not actually buying something like a stock or a future. You're literally just gambling in a market that they created. So if you make money, that money has to come out of their pocket, right? Because they're not really giving you access to a product. They just invented the product. And then it's like a casino. You're gambling about which direction it's going to go. The reason why it works is because there's so many people that come in that are new that want to start with just $1 or $5 or something along those lines. And a lot more people lose than win. And then that's why they can keep the charade going, right? Now, they've turned into a full-on broker, deriv, which is not just a binary options broker. And notice that they have everything like Forex, cryptos, commodities, stocks, and indices. So they're offering those markets in addition to this new kind of scam market, in my opinion. But I would still highly recommend that you absolutely stay away from this market. If you want to be a real trader, you can get into futures or stocks. There's a lot of good traders in the market. I offer a course at Day Trading Academy. I'm developing now another free course for you guys to come in and be able to do that. It's at daytradingacademy.com if you guys want to go there. But please, stay away from synthetic indexes. It's a completely game made up market. In my opinion, it's like a casino, and they literally do manipulate what you're doing, just like I read to you in their quote unquote risk disclosure. Okay. So that's what synthetic indexes are, why you should completely stay away from them. And if there's any other markets you want me to review or a specific broker or anything along those lines, just leave it there in the chat with hashtag Ask Marcello so I can pull it up really quick. And let me know if you guys have any other questions. We'll see you when I see you next time.